Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra and with me is Reema Tendulkar. While the market continues to be under a lot of pressure, we'll discuss that in greater details. But let's talk stock specific now. FMCG major Marico posted Q4 earnings in line with street expectations. It cut down employee expense during the quarter, which in turn aided ad spends. Mangalam caught up with Marico MD and CEO Saugata Gupta and started by asking him about the demand and input cost environment. Listen in.
Both in terms of demand, if you look at it, there was a slowdown even since Q3. Obviously, it's a function of a high base and also the significant inflation which is happening in the environment. As far inputs is concerned, I think recent times, which is when the Ukraine and the geopolitical issues started, again, inflation has been high, and therefore I believe that this is going to be a little bit of a tough situation in the first half of the year. Having said that, we are, I think, a little in a different space, given the fact that 50% of the cost base, which is copra, it's going to be relatively better positioned because there was significant high inflation last year.
Right. So that's what gives you the confidence of staying well ahead of the market growth, because I'm looking at your comments and that is what you've said out there as well. Can you define well ahead? How much higher would it be as compared to the market, and what do you expect the FMCG industry to grow at this year?
I think it's difficult. As I said, things will begin to ease out in the second half. I think our endeavor will be to, as you see, we have continued to invest behind A&P, continue to invest behind the diversification agenda in foods, digital brand and distribution. And therefore, we want to ensure that we protect our market share, we protect brand penetration, and manage to cope with this. And I think it's important because while we strongly believe that we would not like to manage short-term profitability, as long as the operating margin stays in the 18 to 19% space on an annualized basis.
Dabur reported their numbers yesterday as well, and they've gained almost 300 basis points in terms of market share in the honey business. And that brings me to the question of what exactly has happened to the shift that you had made with regards to immunity, the Immuniveda range, and the preference for immunity boosting natural products that took place during the COVID. Has that normalized, and has your focus on that also reduced?
I think as far as honey is concerned, we continue to track well. We have, as you know, a 20% plus share in e-com. We have a double-digit share in modern trade. We continue to maintain our shares in general trade. Honey, as you know, has clocked between 50 to 100 crores, one of the growth drivers of our food agenda. Having said that, I think as far as immunity as a category is concerned, especially things like Chyawanprash and all, they had a significant tailwind during COVID, and that has slowed down. I think, having said that, I think health is a long-term agenda, and we will continue to definitely invest behind honey. I believe it's a long-term proposition in terms of another leg of growth, like soya chunks and oats. As far as Chyawanprash is concerned, I think we have still to get our overall business model right. We will continue to stay focused in some of the selected channels where we are. But I think once these things settle down, as far as long-term is concerned, yes, these are categories of the future. Having said that, I think in the short term, immunity as a category, given the base and given the tailwind, it will settle down at a lower level, but definitely higher than pre-COVID levels.
Right. And let's talk about the digital brands as well. Beardo, you said you were going to clock 100 crore by the end of this year. You've gone ahead, done that. Just Herbs doing well as well. I reckon, together the digital brands portfolio would give you almost 180 crores in terms of revenue. You have a target of 450, 500 crores by FY24. How much of this is online for you? What's the scalability taking these brands offline? And post-COVID, have you seen, an impact on consumer acquisition costs, the unit economics of these brands?
I think as far as consumer acquisition cost is concerned, I think it's an overall industry issue, and in terms of those costs. Having said that, I think both Beardo and Just Herbs are scaling up well, and therefore with the scale up, our overall acquisition cost and our e-cost is coming down. What we also see is because of the fact that we have Just Herbs, we have Beardo, and some of the organic brands like Pure Sense, Coco Soul, there is a lot of synergy in terms of costs, in terms of common tech stack. And it's almost like we see our digital business as a portfolio of brands where there could be significant synergies. I think we are pretty confident about, our digital business in terms which has already clocked sometime as an exit run rate of 180 to 200 crores. And we will look at both organic and inorganic means. I think we continue to be primarily digital, but wherever possible, as the brands scale up, we will look at general trade or modern trade opportunities.
All right, just a couple of questions before we let you go, Saugata. What explains the dip in employee costs and, at what level will ad as a percentage of sales settle at?
So I think as far as employee cost is concerned, we keep on, providing for it every quarter, especially the variable pay and the long-term incentives. And then based on whatever the performance is, you take a call in the Q4. So I think it's just an adjustment. It's not employee. You have to look at employee cost of a full year basis. We continue to invest behind building capability. As far as ad spends are concerned, I think it should remain at around the 9%, 9% is kind of a space. As I said that we have a huge diversification agenda and we will continue to invest behind advertising. Having said that, given that the noise levels might come down in the overall media, given all the inflation and other things, we will try to maintain the SOV levels and will continue to drive effectiveness of our ad spends.
You briefly did speak about inorganic opportunities as well. What's the total addressable market that you're targeting, say, in the next 3 to 5 years? And what new categories do you think are exciting?
So I believe foods is the biggest driver of our growth. And I think as far as foods is concerned, if you really look at it, with every, Saffola has been a very, very under-leveraged brand in the past. And we are expanding the total addressable market through Saffola. We have actually here expanded by 6,000 crores with all our launches, especially recently. We have gone into spreads and mayonnaise and peanut butter. Saffola is a better for you brand, and we are extending into all food categories which have a tailwind, which are low to medium penetration. Similarly, there is significant opportunities in premium personal care. As you know that compared to traditional FMCG companies, a lot of startups in terms of, has been taking significant market share in the top end of the premium personal care. I mean, whether it's in hair oil, shampoos, conditioners, skincare, color cosmetics and all. And I think Marico is very well positioned to play, given, as you know, that our operating model to play and participate in this. Because if we don't participate, it's a future opportunity loss for us.
That's the word coming in from Marico, eyeing the opportunity in foods as well as premium personal category. Margins will be maintained at 18 to 19%, and digital revenues could be 500 crores by FY24. Those are some of the important takeaways. On that note, we'll get into a break. On the other side, we'll invite the management